I'm going to talk about Chapter 10. Chapter 10 switches to the other side of the balance sheet. So if you recall, our balance sheet is assets equals liabilities and owner's equity. And so far we've talked about the major types of assets: cash, accounts receivable, inventories, fixed assets, as well as some other ones, prepaid expenses, and other things. So those are the big types of assets that you have. The liabilities, this chapter pretty much talks about all liabilities at once. So we're going to kind of go through this. It's some parts of this chapter can be challenging, so you can read some of these. But basically, a lot of times we talk about liabilities or things we owe. Okay? And that will honestly get you through the major portion of liabilities. Liabilities are things you owe. Sometimes as far as unearned revenue, when somebody pays us in advance for something, we credit unearned revenue. And that is a liability. We owe them services. So if we're a lawyer and somebody's paid us a retainer, the lawyer would debit cash because they got cash and credit unearned revenue. That unearned revenue is a liability because I owe them services. Another way you could think of it is you owe them their money back if you don't provide the services. So notice they're arising from past transactions or events that require a settlement of the future date. Things we owe, it will kind of get you through most of the idea of it. This book kind of goes through debt versus equity. We can either get the money by borrowing it or get the money from the owner. So I'd encourage you to read through these and see that we're going to focus on liability. You have to pay back debt or you don't have to pay back the owners. There is a due date on the debt. Equity doesn't mature. So a lot of times companies have to choose between debt versus equity. And that's kind of in finance classes and other things. So creditors, if you think about the accounting equation, assets equals liabilities and plus owner's equity. Okay, so let's say that the business goes out of business. So all the assets are sold and the only asset we have is cash. Okay, so cash goes to the creditors and the owners, but the order of that is the creditors get the cash first. So if you have a situation of bankruptcy, chances are the cash isn't even sufficient enough to pay all the creditors, so the owners are out. So that's kind of an important distinction there. I think you all know that a lot of liabilities, you have to pay interest on them. There's a lot of liabilities you don't have to pay interest on. Things you owe, like salaries. If I work today, which I am working today as I'm talking on this video, technically the university owes me money. They won't pay me till later, and obviously they've agreed to pay every 2 weeks or twice a month or whatever your business does, and they don't pay interest on the fact that I've earned it this minute, and they're not going to pay me till later. Estimated liabilities. So do liabilities have to be an exact amount? The answer is no, but a lot of them are. So notes payable, I generally sign a note stating how much I'll pay back. Accounts payable, if a business buys from another business and it pays later. Accrued expenses like salaries payable, utilities payable, again, those are usually an exact amount. Interest payable, salaries payable. But they don't have to be an exact amount. So estimated liabilities, there are two basic characteristics. I know a liability exists, but I can't determine the precise amount until a later date. So a very good example is warranty. And we've estimated things before in our accounts receivable. We estimated the allowance for doubtful accounts. That's not a liability, that's a contra asset, since it's accounts receivable is an asset, and it's an asset I'm not going to get. But the same thing with warranties. We have to actually estimate how many claims under warranty are going to be made. So we're going to talk about how businesses do that, and they generally use past experience. This is kind of important. I'm not really sure what you want to write down, but a lot of this is important, but I didn't feel the need to put a heading for absolutely everything on here. So just make sure you understand liabilities. Current liabilities are those to be paid within a year. Long-term liabilities are everything else. We generally say they won't be paid within a year, but a couple of the ratios that are important. Working capital, notice working capital is current assets minus current liabilities. The example I like to give in class is, if you think about it as a college student, or even you, if you have $50 in your pocket, and you still owe me $20, and you're going to go out for the weekend, the question is, how much do you have to work with? And remember, I said you have $50 in your pocket, but you owe me $20 before the weekend, so you have $30 to work with. So working capital is very short term. This term, liquidity, later on you're going to, in this chapter, we're going to talk about solvency. Liquidity is short term. Solvency is long term. Solvency is the more pressing issue. So I'm sure that everyone has been not liquid at some point in time in their life, especially if you're a high school kid or a college kid, or even if you've had a lot of bills come due. If you've ever, owe your somebody money, and if you say, okay, well, I get paid on Friday, and so I can pay you my $20 on Friday, because I'm getting, you probably don't tell them this, but you're getting paid $500 on Friday. So on Friday you can certainly afford the $20, but today you can't because you don't have enough money in your checking account. So we fix liquidity by doing things like borrowing money. Most of you, if you decided to, if you couldn't borrow money from a bank and you wanted to buy a house, you wouldn't be liquid. But anyway, so liquidity is short term, and there are many fixes for liquidity, like I said, borrowing money. Another ratio that is common is the current ratio, current assets divided by current liabilities. So we all know math, and we all know that if the numerator is more than the denominator, it's greater than 1. So we want to have more current assets than current liabilities. So think about this. Current assets are things that are going to be turned into cash or used up in a year, and current liabilities are things that are due within a year. So we generally want more current assets than current liabilities. That's not to say companies don't hover slightly under 1, because remember, this is a year, and some of my current assets may come in before my current liabilities, so it just may be a timing issue. So again, this is done on the balance sheet at December 31st. So for instance, if you think about your own checking account, and let's pretend the only current asset we have is cash, and I have some bills on my desk, and on December 31st, I had to do a current ratio. Well, on December 31st, maybe my pay comes in on January 1st, although you could say that's a receivable, but we're going to ignore that. I would have December 31st cash lower than my bills, but if I get some cash coming in on January 1st, then I can still pay them. So, but it's a quick indicator. It doesn't necessarily mean there's a problem. Just on that day, they're not liquid. So below 1, they're not liquid. Above 1, they are liquid. And it's just one of the many ratios that you look at in conjunction with one another to apprise how well a business is doing. Okay, so here's some examples of current liabilities. You can kind of write them down and check them off. I have them on this handout, but make sure you know when you study for the exam that you know what each of those are. So accounts payable are generally what a business has a lot of. So if I am a car manufacturer, I will want to set up an account with a steel supplier because I'm going to buy that on a reoccurring basis. So I want an account with them, and I may pay it off on a monthly basis. If I'm Quincy University, I may have an account with uniform manufacturers, Nike shoes, whatever. Heck, I tend to buy a lot, and I want to have it on account, and then I pay them off on a regular basis. So trade account is what I'm in business for and buying. So it's not unusual thing like notes payable, etc. These are just my people I buy from repetitively, and I set it up on account. Then you have other accounts payable that's not for merchandise or not for things that are normally on a repetitive basis. Notes payable are generally with a bank, and that's because somebody wants to charge you interest generally, so they don't say, hey, you can pay off in 30 days. You can't pay off in 30 days, so you sign a note to pay off with interest. Sometimes we can, if you don't pay off your accounts payable, they'll get you to sign a note so they can legally charge you interest, and it holds up a little better in a court of law. Okay, so you can see that notes payable example. I think we all know that. You can read through it. I did not put it on the overhead. But make sure you know this. We've done this in other chapters, and we'll do it a little bit later as with the bonds. So please go through that slowly if you don't understand it. You can always email me about it, but I think it's self-explanatory. How do you classify notes payable? Anything due within the next year is current. Anything not due within the next year is non-current. So you can have a $100,000 loan or note, and let's say a $100,000 loan, and you're paying it off $10,000 over a year over the next 10 years. So in year one, you're going to have $10,000 current because it's due in the next 12 months. You're going to have $90,000 non-current. Then I'm going to pay off the current, and you'll have $10,000 current and $80,000 non-current. Next year, $10,000 current, $70,000 non-current, okay? So basically, the note is going to be classified and split up according to when it's due, current within a year, non-current not within a year. Accrued liabilities, sometimes referred to as accrued expenses. This is an important term to be used in business. And it's asked on a lot of exams and you referred to in papers and things you read, and it's assumed everyone knows that accrued expenses are those expenses that as of year end you still owe, you just haven't paid yet, mainly because of timing differences. So you probably at the end of every month have a lot of accrued expenses. So as of July 31st, you're going to have your utility bill, but it's not due until August 15th. So until August 15th, you have an accrued expense. So it's all just timing issues. So you have some examples are interest payable, income taxes payable, payroll liabilities, utilities payable, etc. All those things that you have bills for that you pay later, but as of month end, they have happened. Next one. Also in accrued liabilities are notice payroll liabilities. Payroll liabilities are kind of unique in that employers are required to withhold some of the taxes from your wages and send them in for you. So not only will we have wages payable, but we'll have payroll taxes payable. And so kind of read up on these. Social Security and Medicare. Portion of it is withheld from your pay, and then your employer pays an equal amount. So if they withhold $50 from your pay, your employer will keep that back and send in $50 of their own for you. So $100 goes in for Social Security and Medicare. Unemployment taxes, make sure that you know these two. The employer only pays, so you'll have unemployment tax expense and unemployment taxes payable. So one kind of important thing about this chapter, a lot of your credits are going to always end in payables. The next thing we're going to get to doesn't. But if it's a payable, it's a liability. So this will be taxes payable, unemployment taxes payable, etc. Workers' compensation is paid by employers, so you're going to have that payable. Then other things that employers pay for you, health insurance, life insurance, they might also pay into a pension plan or profit sharing plan. Things withheld from the employee's pay are taxes, and so instead of paying them to you, the employer withholds them and pays them into the government's. Unearned revenue, we talked about this a little bit before, but if If a lawyer charges a retainer, the lawyer debits cash and then they owe you something. So the lawyer will credit unearned revenue because they haven't yet earned it. When they provide those services, they'll debit unearned revenue to take it out and credit legal services revenue to add it to the revenue account. So some other things are customer deposits. So sometimes, especially if you have a customer that may not have paid his bill ahead of time, you would charge them a deposit, and then you would debit cash and credit customer deposits, and then as you deliver the merchandise, you would take it out of customer deposits, put it in revenue. In some cases, your tuition is actually a customer deposit because the university receives your tuition at the beginning of the semester, and so they will debit cash and credit unearned tuition revenue, or customer student deposits, and then they'll earn it as throughout the semester. Long-term liabilities. Basically, long-term liabilities are due in excesses of a year, and these are just some reasons why you're going to have long-term liabilities. But this one, when do you classify a debt that is due next year as long-term as opposed to current? The only time that you would do this, remember, anything that's due next year is current. Or I'm sorry, let me restate that. Anything you're going to pay next year is current. So if you have entered into a refinancing agreement that even though the debt is due next year, that you're not going to pay it next year, you would classify that as long-term because you intend to refinance that. So notice that if management has both the intent and the ability to refinance soon to mature obligations, you're going to classify them as long-term because you aren't going to pay them. You want your balance sheet to be the things you're actually going to pay next year. You can read that. Okay, so now we're going to talk about an amortization schedule, a loan amortization table, etc. That we know if we borrow money for a car or borrow money for a house, each payment is part interest and part principal. And you can actually schedule this out on Excel. And it does a really good way of, it's a good way to track those, and especially if you decide to pay a little more principal, etc. But on October 15th, year one, King's End purchases furnishings at $16,398. So right here is my $16,398, my unpaid balance. It's an 18-month loan that has an interest rate of 12%. Remember, interest rates are always stated on an annual basis, not a monthly basis. So 12 divided by 12 months is 1% a month. I generally do times 1/12. 12% times 1/12, so I allocate it that way. The monthly payment is $1,000. So I'm going to put period 1, 2, and 3. I only have 3 on this. The overhead, you can look at it and go on. The payment date is November 15th, December 15th, and January 15th. And the monthly payment is $1,000. So right here we should be able to fill in these 3 amounts. Okay? The interest expense is always going to be principal times rate times time. And the principal is the unpaid balance. Okay? This is the, maybe make this clearer, principal payment. Okay? So on the unpaid balance, it's $16,398. So principal, that's our principal, times rate, 12%. And the period of time this payment is covering is 1 month, so times 1/12. So let's go on. Let me try to make this a little bigger. Okay, so we filled out the period and the payments we're just going to do through January, 3 of them. November, December, January. And you already have $1,000 in there. Okay, so how'd they get this 164? It's 16,398 times 12% times 1/12 is 164. Okay, if my monthly payment is $1,000 and my interest expense is 164, then the remaining part of that $1,000 must be principal. So 1,000 minus 164 is 836. Okay, so if I have an unpaid balance of 16,398, and I've paid off $836 in my principal, that minus that is my new principal balance. So $16,398 times 836 is $15,562. So $15,562 is my new principal balance. I wish they would have called that unpaid principal balance. Principal, $15,562 times rate, 12%, times time, 1 divided by 12. Notice they just did 12% times 1 divided by 12 is what I've been saying, but obviously that cancels, they got 1% there. Okay, so they're just taking it times 1%. I'd like to do times 12% times 1/12, because what if they give you 8%? And so then you'll have to take 8% divided by 12 and get some decimal points. So I just take it times 12% times 1/12. Okay, so 15,562 times 12% times 1/12 is 156. 1,000 minus 156 is 844, is paid off of the principal. So 15,562 minus 844 is 14,718. So I take that times 12% times 1/12 is 147. $1,000 minus 147 is 853, etc. So if you notice, the interest keeps going down and the principal balance keeps going up, simply because my payment is always $1,000, and if my principal balance keeps going down and I'm multiplying it times a number, that number gets less and less and less. So this is why people encourage you to pay off more principal in the early years, because if I can make this more, and this really is more in effect not on an 18-month loan, but on an 18-year loan, that this interest expense will be very high, very great portion of the $1,000, and this will be less. So if it's a longer life loan, this monthly payment would be more like $200. So if the monthly payment was $200, $164 was interest, you wouldn't very much have principal. So if I can make extra principal payments in the early life of the loan, I can really significantly decrease my number of payments that I need. Okay, so make sure you do that now. Make sure you have this in front of you, okay? So we're only going to make a couple journal entries. So basically what's happening is I'm paying every month, okay? All right, so we're going to record the first payment on November 15th. Then we're going to make the adjusting entry on December 31st. Actually, we could make the December 15th entry too. Okay, but we're going to do the adjusting entry on December 31st too. Okay, so if you go back to the previous slide, you'll see interest expense is $164. I always do the interest expense. I start with the cash. I start with the credit to cash because I know it's always $1,000. Okay, and then of that $1,000, $164 is interest expense, and I'm going to debit notes payable or installment notes payable, whatever account I put it in when I borrow the money. Okay, then on December 31st, notice it's $14,718. Let me back up a second. Okay. I wish I would go ahead and make this December, go over here and make a December 15th entry. So your December 15th entry is a credit to cash for $1,000, a debit to interest expense for $156, and a debit to installment notes payable for $844. So it's the same debit and credits as that journal entry you made for November 15th, except you're going to use the December 15th numbers. So now my balance is $14,718. Okay, but I want to make the journal entry for my financial statements on December 31st, because on December 31st I have to have it up to date. All right, some people simply take this amount, 147. So this is the amount from right here. That is amount from December 15th to January 15th. So honestly, it wouldn't be off by much if I just took it times 1/2 to get from December 15th to December 31st is the period of time I'm looking at. But they do it like this. So we have 14,718, see that? Move on. Okay, but remember I'm not paying it on December 31st. So what happens is I have interest expense of 74, so interest 14,718 times 12% times 1/12 times 1/2 is $74. Or again, you could have just divided the other one in half and got about the same number. But since I'm not paying it yet, it'll be 74. And then when I actually pay, I don't think they make it here. When they actually pay it, I'm going to have a credit on January 15th. I'm going to have a credit to cash for $1,000. I'm going to have a debit to interest expense for the other portion of it. Let me go back. I did 74 already. So it's 147 minus 74. And credit to cash for that. Debit interest expense for 147. I'll do installment notes payable for 853. And this 147 is broken out into two things. One that was December 15th to December 31st. I forget the number, but I think it was 74. Okay? And then so I have $73 that pertains to December or January 1st to January 15th. So this is in interest payable, so I debit interest payable for the 74, debit interest expense for 73, debit installment notes payable for the 853, and those three should add up on my debit side, and I credit cash for $1,000. Okay, bonds payable. Bonds payable are unique. Generally, bonds payable are used when you need a very large amount of money. And notice that they're usually denominated in $1,000. Okay, so let's say I needed $40 million. So the city of Quincy recently issued bonds to build several new schools. So what could they do? They could go to some banks. Again, I don't know what the amount was, so I'm just saying $40 million. But let's say I need $40 million, and I go to a bank, and they laugh at me because I cannot get $40 million from a bank. And then maybe I even try to go to two banks, and again, 2 or 3 or 4 banks won't lend me that amount of money. But what I can do is I can issue bonds, and a lot of municipalities can issue bonds because there are also tax savings when a school district issues bonds. You don't have to pay federal income tax on it. So they'll issue bonds, and what a bond is in essence a piece of paper that, it doesn't say this, but it might as well say, will you loan me $1,000? And everybody that buys, and I'm going to put quote around buys, that buys a bond, in essence, hands the school district $1,000, and the school district pays them back $1,000 plus interest. So you don't necessarily buy a bond, you loan the school district money of $1,000. So therefore, I personally, as a citizen, might want to buy 1 school district bond, or I might want to buy 10. Or a larger bank might want to buy 100, so they can loan them $100,000. So what it does is it's an efficient way to allow individuals to loan money to the school district just in small increments of 1,000. There's usually an underwriter and an intermediary that deals with the interest and who they owe the interest to, et cetera, et cetera, et cetera. So it's just an efficient way. So it's kind of incorporates loans with some of the advantages of stock, where you can sell $30 shares of stock to a lot of investors, but this is loaning them money. So again, you can buy 1 bond for $1,000, or you can buy 10 bonds, or you can buy 100 bonds, or you can buy 1,000 bonds, etc. Okay, the principal is usually paid at the end of the bond period, so this $1,000 is paid back. So what they do is, in my $4 million that I need, I would just divide that by $1,000 to determine how many bonds I'm going to sell. So the $4 million bonds, the underwriter, the person in charge of accounting for it, if you will, knows it's $4 million, but made up of a lot of $100,000 bonds that they're selling. Okay, they actually print an interest rate called the contract rate of the bond, and interest is usually paid twice a year, and the amount that they pay is the principal times that stated rate. So in this case it'd be $1,000, but we generally make the journal entry for the entire bond issue at once, not for each $1,000 bond, times the time, okay? And generally the time, again, is semi-annually, so this would be 6/12, unless you have December 31st falling in there. Okay, but an important thing to note here is the stated rate, and these are printed on the bonds. So what happens if between the time the bonds were printed and the bonds were issued, the interest rate has changed? Or what if I want to sell my bond to somebody else and the market rate of interest has changed? And the way we adjust for that is we sell the bonds either cheaper or more expensive depending on what the market rate of interest is. So here's all your information. The bonds are issued, and intermediary is the underwriter, and so they're kind of combined together, pieces of paper printed, et cetera, et cetera. So you could probably guess there's got to be a lot of organization around a $4 million bond issue, which indicates they're going to lend money out at $1,000 increments. Okay, so bond prices are usually quoted as a percentage of face amount. So remember I said the bonds have a stated interest rate. So if the stated interest rate is 10% and the market interest rate drops to 8%, okay, you have $1,000. Would you rather invest your $1,000? I'm not talking about the issuer, I'm talking about the buyer. We're going to make the journal entries for the school district, the one that issues it. Would you rather, if you were buying it from the school district, would you rather earn 10% or would you rather earn 8%? So this is the market. Well, the answer is we all want 10%. Okay, so if the market rate of interest is below, everyone's going to want these bonds. So what happens in economics, supply and demand, when everybody wants a bond? Well, somebody else will say, well, I'll pay a little bit more than $1,000 for it because the market's only earning 8% and this is 10%. So if I paid $101,000 for it, I'd still be earning more than I would anyplace else. So what happens is this price of this bond increases until the return is 8%. So if you think about it, I'm going to pause it for a second. Okay, so if you look at this, this is our bond. Okay, if the bond sold for $1,000 and earned 10% interest, it's going to pay $100. That's on the face of the bond. That is what it's going to pay. Here's what our market is. Somebody invests in a $1,000 bond, or I'm sorry, invests in $1,000 anything, they earn 8%, and it's 80. So now everybody's going to want these. So what's going to happen is we set this. We know that this is $100. Okay, but what we're going to do is we're going to adjust this bond price until this interest rate is not 10%, but it's earning 8%. But remember, this is given. Okay, it's going to, because it's written on the face of the bond. However, we don't have to sell the bonds for what's on the face of the bonds. Okay, so just think about, you go into buy a car and that car sticker price is $30,000. You don't have to actually pay that. But this is going to, the bond is going to earn 10% of what's on its face. So think about that. It's 10% of what's on its face. So actually you can sell zero coupon bonds and not pay interest, and you'll see that they get really cheap. So sometimes on the TV you'll hear, if interest rates rise, bond prices fall. And the reason is the amount of cash they're paying is given. So I want this $100 to be 8%. So I'm going to type in $100 over here because that's now given. And I want this to earn 8%. Okay, so now I want to figure out what it's going to sell for. So if I sell that $1,000 bond for $1,250, so $1,250 times 0.08 is $100. Okay, so now both of these are earning an 8%. So I just raised the bond price until that $100 was 8%. Okay, and now it's the equivalent. So obviously I have to have $250 more here, but this is given. Okay, and similarly, if the bond is at a discount and it's selling for less, or the printed thing on it is less than $1,000. Okay, and let's say it's 6%, and so you have $60 here. Nobody's going to want to buy it. Okay, so what do? You put it on sale, so the $60 is you put it on sale and it goes down. So notice I used 6%, 8%, and 10% there, and the difference is $250 both ways. You cheapen it, so the $60 is a better interest rate. So we're back to here. So remember, one is sold at $1,250, so we would say that's priced at 102.5% of face. So 102 is the percent of face. So 102 is $1,000 times 1.02. And my other one, it was sold for $750. We would say it's priced at 75 or 75% of face. So make sure it's a percentage of face amount. You understand that. Okay, you can kind of read this there. Here's the different types of bonds. What is bonds payable and what are some types of bonds? And you can kind of read through those. Ask me if you have any issues with those. Those are just definitions you should know. And you can read tax advantage of bonds. We can deduct interest. You cannot deduct dividends, so that's important. And you can read through that. Okay, so here's what we're going to do. We're going to issue the bonds. We're going to account for the semi-annual interest payments. If that semi-annual interest payment is not on December 31st, then I have to accrue interest. And when I say December 31st, I'm just assuming that's their year end. Companies can have different year ends. And then we're going to account for the retirement of bonds. So these are the 4 things that you should know, so make sure you practice them. Okay, so the first thing I'm going to do is issue it at face. Issuing at face is the easiest by far. So they issue $1 million of 6% 20-year bonds. So sometimes the first thing I do is write up here interest equals. And so I take $1 million times 6% and I put equal. So we got what, $6,000? And then it's payable semi-annually. So I take it times 1/2. And we're going to pay $30,000. I think I said $6,000. I meant $60,000. So $1 million times 6%, $60,000, paid twice a year. So divide it in 2. So I'm going to pay March 1st, put a little arrow, pay $30,000. September 1st, going to pay $30,000. Okay? So when I issue the bonds, I'm the company selling them. I'm the company borrowing the money. So I debit cash and credit bonds payable for $1 million. So record the issuance. So on September 1st, remember I said I was going to pay $30,000. So debit bond interest expense and credit cash. On December 31st, I have paid it on September 1st. So I have September, October, November, and December that I need to adjust for. So remember, the next payment is $30,000. But as of December 31st, only 4 months have gone by. So I'm going to debit interest expense for 4/12 or 4/6 of that. You'll get the same number. So we did $30,000 times 4/6, which is 2/3, which is $20,000. They just did the computation over. So either way, you're going to get the same $20,000. So bond interest expense for $20,000, but I'm not going to pay it yet, so I credit bond interest payable. And then on March 1st, I'm going to pay all $30,000, So I have January and February, so 2 months of the 6 months. So $10,000 is going to be interest expense. The $20,000 is going to come out of payable, and I'm going to pay $30,000 cash. So I'm going to debit bond interest expense for $10,000, which is January and February. Bond interest payable, that's what I set up last year, and so that was September, October, November, December, and then the cash is for the 6 months. Okay, so you can do it by the fraction of the years. I had already multiplied it times 1/2 to get the $30,000 here, so I didn't set it up on the whole year, but obviously it's the same number. Okay, what happens when you sell the bonds between interest rates? Well, you only earn interest when that bond is yours. So what happens is the seller charges you for that interest. So for instance, if the bond is $1,000 and you're going to get, in that case, a $30,000 interest payment, but you only owned it for 1 month, they're going to charge you for the interest that you're getting that you didn't earn. So we'll do one of those, you'll see it. Okay, so assume Wells issues $1 million of 6% bonds par value, so they issue it at face, which is $1 million, 2 months after the interest date printed on the bonds. So the corporation is always going to write a check for the underwriter, is only writing a check every 6 months for the same amount every time. So notice I have bonds payable of $1 million, that's always face, that's kind of important. But bond interest payable is $1 million times rate is 6% times 2/12 of $10,000. So we're going to have to pay that, but I'm charging them for it. So if you notice, this is a wash. I'm getting the cash, but I'm going to pay them back later. So when I actually pay them back, notice I have the 4 months of $20,000 as interest expense. I debit the payable for the $10,000 that they paid me. Now I'm handing it right back to them in cash. So in essence, the buyer hands me extra $10,000 cash right there, and then the interest payment, I hand it right back to them. Okay, so it's kind of a wash thing. All right, now we're going to talk about what is a discount or premium. So we talked a little bit about that. Sometimes I think about this like in a discount store. Let's go down here. Always know that equal to market rate is face value. But if it's below market rate, the bonds are not as appealing. So let's say the market rate's 10%. Okay? If the bonds pay 8%, who wants an 8% bond when you can buy something for 10%? The answer is no one. So what do you do in a store to get rid of merchandise nobody wants? You put it on sale. So cash received is less than the face amount. So you reduce the selling price of the bond until people want it. What happens if the bond is paying 12%? And the answer is everybody wants it, and you've all taken economics, and when everybody wants something, the price of the bond goes up, and the price of the bond will go up until everyone is indifferent as to whether they buy a 10% bond or your bond at 12%. Remember, that's the cash it's going to pay off of the face. It's not what you sell it for. So it's going to go up until that cash payment is 12%. So make sure you know that, and that explains why on the news you hear when interest rates rise, bond prices fall. So here's this one right here. So it's a principal of $1 million. It's issuing at 97% of face. So think about it. What must be the market rate? Well, this is selling 6% is the interest rate it's paying. Well, obviously, if we're selling at a discount, the market rate must be above 6%. We have interest rates on September 1st and March 1st, and the maturity date is in 20 years. So I didn't put this date because sometimes they keep the same numbers, and I can just leave it like that. Okay, so we have principal is bonds payable. Bonds payable is always recorded for the principal. Always. This is the cash I get. Okay, so if I'm going to debit cash for $970,000 and I'm going to credit bonds payable. Obviously, I don't balance, so I have a $30,000 discount. Figure that out. Okay, so my journal entry is cash $970,000. Bonds payable is always the face. And then I have a discount of $30,000. So discounts are debits. If it would sell at a premium, this would have been more than $1 million, and my premium would have been a credit. So how does it appear on the balance sheet? So notice it appears here. So it's sort of like fixed assets, where I have the cost of the fixed assets less accumulated depreciation, and over here is the book value. This is the book value of the bond. The bond's payable less the discount, simply because I have to print an interest rate on it, and by the time I print it and I sell it, the interest rate has changed. So then when I have, go back to this, what does this $30,000 represent? That $30,000 represents the difference in the interest rate. So if you remember, I'm always paying the interest payment. I wish that $30,000 wouldn't be the same as the interest. So let me see what this is. So if you would write this out, so $1 million times 0.06, because that's the stated rate. So that's 60,000. And then I'm going to pay right here 30,000 each. Okay? So I'm going to clear that. Hopefully you'll write it out better than I did. So every time I'm going to actually write a check for $30,000. This $30,000 I'm writing a check for is not to that $30,000. It's just a complete coincidence that it is. Okay, so we have that all written out there. Okay, so this represents the difference in interest rate. So if you recall, I sold the bonds. The bonds are paying $30,000 of interest. Okay, right here I put $30,000. Okay, but I sold them at a discount, which means I sold them to earn more than 6%. So I put them on sale so that $30,000 interest payment is more than 6%. All right, so you should be thinking, gee, I don't balance, and we'll see that. And what happens is I amortize this discount. Okay, so I have 20-year bond, but I'm paying interest twice. So 40 periods, so $30,000, that's the $30,000 discount, not the $30,000 interest. Okay, it's this thing right here. It's that $30,000. Okay, so I'm going to get rid of it, $750 each period. So I'm going to credit cash for $30,000, the amount that I wrote up here I'm paying. Notice in your original entry up here, you debited discount, so now I'm amortizing it or getting rid of it at $750 credit. So that means my bond interest expense is a debit for $30,750. At maturity, I just get the bonds payable off my books and pay back the cash. So notice that's 20 years later, I'm paying it back. Okay, what happens if I'm issuing them at a premium? Okay, so at a premium, they sell for more than the face value of the bond. So I debit cash for $1,030,000. I credit premium on bonds payable, and I credit bonds payable. So remember, bonds payable is always the face, always the face. Okay. And that's what it looks like on your balance sheet. The interest expense would be, cash is always $30,000 because that's what I'm paying, and I know the premium in my previous journal entry was premium was a credit. So when I amortize it, I get rid of it. So I debit the premium, which forces my bond interest expense to be less, which should make sense because they sold at a premium. So my interest expense is to pull that interest rate down. You can kind of read through that. You can read through that. Discount rate or effective rate is what it's earning. It's usually what we try to do is get the discount or effective rate to be equal to the market. Okay, what happens when I retire it early? What is retiring a bond? It's when you call it in. This used to happen quite a bit. In the late 70s, early 80s, interest rates were 15, 18%. And so corporations had 20 or 30-year bonds paying 15 or 18%. And sometimes you can issue bonds that are callable, which means you say, I can buy them back at any point in time. So what companies found out it was way cheaper to do, it was way cheaper to pay for a new bond issue and use that new bond issue to retire the old bond. So if you've ever refinanced your house, so let's say I got out of college and I wanted a house and I bought a $100,000 house, but the interest rate was 6%. So I'm paying $6,000 of interest a year. And suddenly the interest rate went down to 2%. Well, what I might do is go to the bank and say, hey, can I borrow money at 2% to pay back my 6% loan? And so that's why I'm retiring bonds early, generally to issue new bonds at a cheaper interest rate. So if I pay back, if I get the bonds off my books, remember these bonds were on my books up here for $1 million. If I have to pay more than $1 million for it, I have a loss. So I get the bonds payable as a credit, so I debit bonds payable. I credit cash, so if I have to pay back more than $1 million, I need to debit the balance, I have a loss. If I need a credit the balance, I have a gain. It's kind of as easy as that. Write it out, you'll see it. Estimated liabilities. So we talked about warranties. You have to estimate them. Okay, so notice estimated liabilities have some uncertainty. Two big estimated liabilities are warranties and lawsuits. Okay, so loss contingencies are different. Loss contingency is stemming from a past event that is expected to be resolved in the future. Actually, estimated liabilities and loss contingencies are very similar. But the loss or expense related to an estimated liability is known to exist. So I really wouldn't get concerned about, I don't believe I've ever seen a question of how is an estimated liability different from a loss contingency. Ever, I don't think I've had that. Okay, so estimated liabilities appear in the financial statements. Liabilities are known to exist, and you can't, estimation is a little bit difficult. A loss contingency, sometimes, let me see if they categorize this, probable, reasonably possible. Okay. Sometimes we have to, let's say we have a lawsuit. Okay. We know that lawsuit, we're going to lose some money, but December 31st happens and the lawsuit is still in the trial phase. So we have no idea how much money we're going to lose, but we think we're going to lose some money on it. The unknown is how much are we going to lose. So what you do is, if you can book an amount, you do book an amount. If you cannot book an amount because you don't know, you disclose it in the financial statements. Some other loss contingencies, again, notice they're going in great detail. In contrast, the loss or expense related to an estimated liability is known to exist. So you could say in that lawsuit it is an estimated liability because we know that it exists. However, if we don't know it exists, we call it a loss contingency. I think they're splitting hairs a little bit on the difference between the two. Other loss contingencies you can have is, there are always potential EPA loss contingencies that I know that, let's say that we do discharge pollutants in the Mississippi River, and I had a leak, and so I know I have a loss contingency there to determine that. Okay, so this one defines a loss contingency. Again, they are still estimated anyways. Okay, so if I said this before, if it is probable that the loss is being incurred and you can reasonably estimate the amount, then you do need to go ahead and record that amount. So if I know the amount of the lawsuit with reasonable accuracy, how much I'm going to lose, or I have an amount that is pretty accurate that I think, I go ahead and book that. Otherwise, I disclose them in the notes. The terminology is probable, reasonably possible, and remote. Some we get sued for various reasons. If we don't feel it, if we feel it's a frivolous lawsuit, we wouldn't disclose it. Okay, and so you can see that this is how they booked their loss, or I'm sorry, not booked it. Said disclose their loss contingency. It is not possible at this time to determine the ultimate legal or financial responsibility. A commitment have to be disclosed in notes. Commitments are when, let me give you an example of a commitment. Let's say I have signed a long-term agreement to buy a certain amount of steel because I'm a car manufacturer from U.S. Steel, and I have agreed to do that. But I haven't yet taken possession of that steel, so I don't have an accounts payable yet. So what do I do with that commitment? I disclose it in the financial statements. So here's some other examples of a commitment. So if I have if I'm building a new building, I will have to disclose that I have a commitment to pay the contractor a certain amount of money. And it's just something investors want to know, that you've committed to pay somebody something. Okay, and then the last few things in this chapter are the ratios. These ratios kind of talk about how, notice it's operating income divided by interest expense, which basically tells you how many times over you can pay your interest expense a year. Leverage is how much debt you have compared to equity. So basically, if you have a lot of debt, you're said to be highly leveraged. And you can read that through. Special types of liabilities. Some other liabilities that companies have that they have to disclose in their financial statements and sometimes book amounts for are long-term leases, where you agree to lease something for many years, and in fact you have to disclose numbers and amounts in your financial statements for it. Post-retirement benefits, a lot of these are pensions are a big one, where the company promises to pay some pension costs after you retire. Sometimes they pay health insurance costs after you retire. And then deferred income taxes is just a very advanced topic that results because your income on your tax return may be different than your income on your financial statements, and so you have deferred taxes as a result. And I believe, besides really knowing those terms, that's really all you need to know in this chapter. And we are done.